Hey everyone, welcome back to Corporate Decoder, where we uncover the hidden stories in financial filings. Today, we're diving deep into a rather chunky document from Tidal Trust II, a report that is basically a yearly checkup for a whole bunch of Defiance exchange-traded funds. Think of it as a detailed report card on how these ETFs have been doing. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we dissect this stuff further. So what exactly are we looking at here? We've got a detailed look at 9 different Defiance ETFs. These are funds that track specific market segments, and this report, filed on the 7th of November 2025, covers their performance up to the 31st of August 2025. Now, some of these funds are super new, having just started operations in 2025, while others have been around a bit longer. This report is all about their money, what they invested in, how much they made or lost, and all the nitty-gritty financial details. Let's start with the Defiance AI and Power Infrastructure ETF, or AIPO. It's a really new fund, only launching in July of 2025. For this reporting period, its total fund size was about $9.5 million. Not huge yet, but remember, it is just getting started. It held 54 different investments, focusing on sectors like consumer non-cyclical at over 46%. When we look at its top investments, we see companies like GE Vernova Incorporated at almost 9%, Eaton Corporation PLC at over 7%, and Quanta Services Incorporated also around 7%. So it is putting its eggs in a few key baskets related to power infrastructure, and presumably the companies that support AI operations, like data centers and necessary hardware. The report mentions that its strategy benefits from investor interest in AI hardware, data center infrastructure, and grid modernization. That makes sense given the fund's name and its top holdings. Next up is the Defiance Gold Enhanced Options Income ETF, ticker GELDI. This one is also relatively new, starting operations in April of 2025. For a hypothetical $10,000 investment, the costs for this period were about $43 or 1.01% compared to the S&P 500 Total Return Index, which gained over 15% during its reporting period. This gold-focused ETF saw about a 2.66% return at NAV. That is a significant difference. Interestingly, the report states that the fund's performance was positive and paid out high monthly dividends due to selling weekly option premiums. This strategy aims to generate income from selling these premiums, while also capturing some upside from gold's movement. However, the gap between its performance and the S&P 500 shows that focusing on income generation through options, even on a strong performer like gold during certain periods, doesn't always keep pace with broad market gains. This fund's investments on the 31st of August 2025 were heavily weighted towards money market funds at over 52% and US Treasury bills at over 40%, with only a small portion in US Treasury securities. It also had a negative position in written options, meaning it sold options, likely to generate income. The top holding is the First American Government Obligations Fund, which is essentially a cash management vehicle. This indicates a very conservative approach, focusing on income and capital preservation rather than aggressive growth. Now, the Defiance Large Cap XMAG 7 ETF, ticker XMAG, this fund launched in October 2024 and tracks the S&P 500 index, but excludes the 7 biggest tech stocks, often called the Magnificent 7. Its strategy is to focus on the other roughly 493 stocks in the S&P 500. For a $10,000 investment, the costs were quite low, just $32 or 0.35%. From inception in October 2024 to the 31st of August 2025, this ETF returned about 8.58%, while the S&P 500 Total Return Index gained over 11%. The report explains this by noting the exclusion of the Magnificent 7, which have indeed driven a lot of the market gains in recent years. By avoiding that concentration, XMAG aims for diversification and participation in other sectors like financials, healthcare, and industrials. The risk here is clear. If those Magnificent 7 stocks continue to soar, this fund might lag behind. Looking at its sector breakdown, consumer non-cyclical makes up over 21%, financials also over 21%, and information technology around 13.8%. This shows a more balanced exposure across sectors compared to the S&P 500, which is heavily tilted towards tech. Its top holdings include Broadcom Incorporated, JPMorgan Chase & Company, and Berkshire Hathaway. Let's look at the Defiance Nasdaq 100 Income Target ETF, ticker QQT. This fund started operations in June 2024. The costs for a $10,000 investment were $108 or 1%. For its reporting period, it returned about 10.40% since inception compared to the S&P 500 Total Return Index at over 16%. This fund aims to generate income by selling daily option spreads on the Nasdaq 100 index with a target distribution rate of 20% per year. Its investments are 100% in exchange traded funds, specifically the Invesco QQ Trust Series 1, which tracks the Nasdaq 100. The rest of its holdings are in options, contracts, and cash equivalents. The report highlights its strategy of selling daily call option spreads, which offers upside participation beyond a soft cap. Unlike traditional covered calls, the report also notes that an April surge in volatility provided opportunities to capture premiums. This one, the Defiance Nasdaq 100 Enhanced Options and Zero DTA Income ETF, ticker QQE, has a longer track record starting in September 2023. The costs for us were $105 for a $10,000 investment, or 1.01%. This ETF has shown a more impressive performance since inception, returning over 12%. Though it still slightly underperformed the S&P 500's over 22% return since inception. The report says this fund generated positive total returns while paying out substantial monthly and weekly dividends by selling daily, near the money Nasdaq 100 index put options. The strategy here is to generate income from these option premiums, helping to offset daily moves where the index might be down. The high turnover in its holdings, 658%, indicates very active trading, which is expected given its strategy of selling daily expiring options. Its investments as of the 31st of August 2025 are concentrated in US Treasury bills at over 52%, US Treasury securities at over 23%, and cash at almost 25%. It also has a small negative position in written options, meaning it sold options. This structure, heavily invested in short-term government debt, is designed to provide a stable base for generating option income. Moving to the Defiance Oil Enhanced Options Income ETF, ticker RUSOI, this one started in May 2024. The costs were $116 on a $10,000 investment, about 1.11%. Since inception, it returned around 4.09% compared to the S&P 500's nearly 19.33%. This fund aims to generate income by selling weekly put options on the United States Oil Fund LP, or USO. The report notes that during the period, implied volatility on USO was generally muted, but a rise in volatility in April and later in the summer due to geopolitical events provided opportunities for the fund to meet its income goals. Its holdings are heavily weighted towards US Treasury bills at over 52% and US Treasury securities at over 25%, with cash making up over 21%. This indicates a conservative approach with a focus on generating income from options on a volatile underlying asset. Next, the Defiance R2000 Enhanced Options and Zero DTA Income ETF. Ticker UMI, this fund began in October 2023. The costs were $110 for $10,000, or 1.05%. Since inception, it has returned about 14.76%, which is quite good, though still below the S&P 500's nearly 28.72%. This fund generates income by selling daily 0-day to expiration, or 1-day to expiration, put options on the Russell 2000 index. The report highlights that the Russell 2000 Volatility Index was elevated, providing ample opportunities to capture premiums. Its holdings are also very conservative, primarily US Treasury bills, US Treasury securities, and money market funds, demonstrating a strategy focused on stable assets to support its option strategy. We have the Defiance S&P 500 Income Target ETF, ticker SPITE, launched in March 2024. Costs were $94 on $10,000, or 0.89%. Since inception, it has returned about 14.33%, again trailing the S&P 500's nearly 18.24%. This fund is almost entirely invested in the iShares Core S&P 500 ETF, or EF. This means it is essentially gaining exposure to the S&P 500 through another ETF, and then layering its income generation strategy on top. It also uses options contracts. The report explains that it generates income by selling daily near the money S&P 500 call spreads, aiming for income and some upside participation. Finally, the Defiance S&P 500 Enhanced Options and Zero DTA Income ETF, ticker WDTA, also starting in September 2023. Costs were $108 for $10,000, or 1.03%. Since inception, it has returned about 12.58%, while the S&P 500 has returned over 22.65%. Similar to the Nasdaq 100 Enhanced Options Fund, this ETF sells daily options on the S&P 500 to generate income. Its holdings are predominantly US Treasury bills and US Treasury securities, reflecting a strategy centered on stability to support its options trading. The report notes that higher volatility stemming from geopolitical uncertainty and Fed actions provides ample opportunities for the fund to achieve its targeted income. Now let's talk about what really matters, the money. In this filing, they've detailed the fees incurred by each fund, for instance. The Defiance AI and Power Infrastructure ETF, a brand new fund, has a really low expense ratio, just 0.69% for a $10,000 investment. The Defiance Gold ETF, however, has a higher cost at 1.01%. For the large cap XMAG 7 ETF, the costs are also very low at just 0.35%. These fees are important because they directly eat into your returns. The largest fund by sheer size in this filing is the Defiance Nasdaq 100 Enhanced Options and Zero DTA Income ETF, with nearly $186 million in assets. That is a substantial amount, showing strong investor interest in its high-income strategy. On the flip side, the Defiance AI and Power Infrastructure ETF is the smallest, with just over $9.5 million in assets, which is expected given its recent launch. A consistent theme across many of these income-focused ETFs is their strategy of selling options. Take the Defiance Nasdaq 100 Income Target ETF, for example. It sells daily call spreads, and the report stresses that higher implied volatility, due to things like tariff fears and geopolitical unrest, provides ample opportunities for the fund to meet its income goals. The underlying message here is that these funds thrive in more volatile markets, because that is when option premiums are higher. But this also highlights a major risk. These funds are heavily reliant on option premiums, and their performance is directly tied to market volatility. If markets become too calm, or if there is a sharp, unexpected downturn, their strategies could lead to significant losses. Especially since they are selling options on indices like the Nasdaq 100 or the S&P 500. The report itself acknowledges this, stating that for funds using options, there may be an imperfect correlation with underlying investments and the potential for substantial downside. Looking at all these funds, there is a clear strategy at play. Some are focused on thematic growth, like AI and power infrastructure, while others are laser, focused on generating income through options strategies on major indices or commodities. The income funds in particular seem to be betting on market volatility to generate those premiums. Their conservative holdings in treasury bills and money market funds provide a stable foundation, but their ultimate performance hinges on successful options trading. Now, for my take on this whole report, Defiance ETF seems to be carving out a niche with these income-focused strategies, especially those using daily options. The fact that they can attract substantial assets, like with the almost $186 million in the Nasdaq 100 Enhanced Options and Zero DTA Fund, shows there is a real demand for income generation in the current market. However, the core weakness for these income funds is their reliance on volatility. While volatility can be a friend for generating premiums, it also means the underlying market is uncertain, and these funds are exposed to the risk of sharp downturns. The performance numbers clearly show that while they generate income, they often lag behind broad market indices like the S&P 500 when those indices are in a strong bull run. The newer funds like the AI and Power Infrastructure ETF are still finding their footing. It will be interesting to see how they perform as they gather more assets and experience different market cycles. The key takeaway is that if you are looking for steady income and are comfortable with the risks tied to options trading and market volatility, these funds might be worth a look. But if your goal is pure capital appreciation, you might want to stick to broader market trackers. Alright, that is our breakdown of this Defiance ETFs filing. What is your take on these strategies and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.